Hello and welcome to another tutorial video. This time we're going to be discussing transaction value, enterprise value, and what the true purchase price in M&A deals is. Now this is a very common question we get. It goes something like this. Can you explain the true purchase price in an M&A deal? Is it the purchase enterprise value, the purchase equity value, the transaction value? What is the difference between all these terms and why is this so confusing? So we actually have covered this topic a long time ago, but the old video overcomplicated the answer and made it more difficult than it needs to be. So I'm going to attempt to simplify and explain it more clearly here and also give you some better Excel examples to illustrate the main points. If you want those files and a written version of this with screenshots, you can go to this URL right here. Just search for enterprise value versus purchase price BIWS. I'll also pin this in the comments. So now let me give you the short answer in a few minutes, and then we'll expand on this and go into some more details and go through an Excel demonstration as well. The true purchase price is the purchase enterprise value, or at least I would consider that to be the true purchase price in probably 99% of scenarios. This best represents what the buyer pays for the seller. Now, sometimes you will make some adjustments to this, which we'll get into, but this should be considered the true purchase price in an M&A deal. The seller's shareholders get the purchase equity value because they only get paid for the shares that they hold. And even if it's something like a cash-free, debt-free deal that's based on purchase enterprise value, the debt gets repaid with the seller's cash, and any remaining cash goes to the shareholders. In other words, you subtract debt and then you add cash to get their proceeds. And so it's exactly the same as the bridge between purchase enterprise value and purchase equity value. Where it gets tricky is that from an M&A modeling perspective, if you're calculating EPS accretion dilution, for example, the purchase equity value is actually more relevant than the purchase enterprise value in many cases because the seller's existing cash and debt make a very marginal impact, if any impact at all, on the overall model. And I think this is where the confusion comes from. Yes, the purchase enterprise value is the true price, but from a modeling perspective, it's not necessarily the most important thing. In terms of this idea of transaction value, I found it to be very vaguely defined, and most often people tend to use it when they don't know if they're referring to the purchase equity value, the purchase enterprise value, or something else, like the percentage acquired times the purchase equity value in case it's not a 100% acquisition. So when you see something like this, you need to investigate it a little bit further and clarify what they mean. Capital IQ also makes this point very confusing because they have this metric that I'll show you right now. I'm bringing up this deal between Chevron and Hess for about $60 billion. They have this metric called total transaction size right now. And if you click it and you look at what it says, essentially they are taking the purchase enterprise value or the implied enterprise value, and then they're adding the cash and short-term investments. And I have no idea what this is supposed to represent, but I think these types of calculations make the concept confusing because people start calculating things without actually understanding what they're doing. If you see some language such as including debt or including assumption of net debt in press releases, these terms refer to the purchase enterprise value of the deal. So for example, in this Wall Street Journal article about the Chevron Hess deal, they have this language about including debt, the transaction has a total enterprise value of $60 billion. So that's pretty clear. They're referring to the purchase enterprise value there. Whereas the headline at the top of the article, the $53 billion, this is the purchase equity value in the deal. However, in this case, we would definitely consider the $60 billion to be the true purchase price. So those are the basics. Now let's go into the details. So I'm going to go through first why the purchase enterprise value is the real price. Then we'll talk about the seller proceeds in an M&A deal. And then we'll go through the true price in M&A models. As a baseline assumption, the buyer must pay to acquire the seller's common shares, and it usually pays a premium to do so. If you pull up the Excel model we're using here, you can see that company B, the seller, has an equity value of $825 million, and company A, the buyer, pays a 20% premium to acquire company B. So this is the baseline. This is the purchase equity value, and it's around $990 million here. The purchase equity value equals the offer price times the common shares. When you think about the seller's debt and cash, there are a couple options. The buyer could assume the seller's debt and simply take it over, or it could refinance the debt. In other words, it could raise new debt and then use the proceeds from that issuance to repay the existing debt, or the buyer could simply repay the seller's debt entirely with its own cash on hand. Now, this last case is pretty rare. You hardly ever see it, but it is technically possible. The important thing to realize is that no matter what the buyer does, effectively it is paying for the seller's debt because the issuance is now its responsibility. If it assumes the issuance, now it has to repay that in the future. And if it refinances it by replacing the existing issuance with a new one, it also has to repay that new issuance in the future. Now, some people will argue that refinancing the seller's debt is not paying directly. So the buyer is not really paying anything directly for the seller, but it is issuing new debt to fund the deal, and we would definitely consider that to be a form of payment, even if it's not a direct cash transfer to the seller. With the cash, there are really two options here. The seller's cash can either get distributed to shareholders as the deal closes. This is what happens in cash-free, debt-free deals for private sellers. Or the buyer could simply retain the seller's cash post-deal close, and the combined cash balance will be equal to the buyer and seller's cash with some adjustments. In the case of a distribution, the seller's cash reduces the purchase equity value because the net assets are lower after this distribution. And in the case of retention, the buyer gets the seller's cash when the deal closes, so that reduces its effective price. Now, in this retention case, the purchase equity value stays the same, but if you think about it, afterward, since the buyer is getting the seller's cash, effectively it is paid less for the seller. And so in either case, the seller's cash reduces the effective price that the buyer is paying. And that is why the true price is equal to the purchase equity value plus debt minus cash, which is the same as the purchase enterprise value. Let's go to Excel and look at this. Let's go back to the same model. You can see the sources and uses schedule down here. And if you looked at this and you wanted to calculate the true purchase price, you would start by taking the purchase equity value right up here at the top, the 990 million, and then you would add the target's debt right here, and then you would subtract the target's cash right here, and then you would add up all these, and this just gives you the purchase enterprise value. And this is what you'll typically see used in analyses such as precedent transactions. Anyone looking at the deal would probably consider this to be the true purchase price as well, based on the public information. Now, I do want to discuss one other aspect to this, which is that you will sometimes see adjustments to this purchase enterprise value. For one thing, there are always fees associated with the deal, such as for legal, advisory, and accounting services. If there's debt involved, there will also be financing fees. And so you could arguably add these to the purchase enterprise value to get the true purchase price. No one really does this in real life because the data is not disclosed and these fees tend to be very small, but you will sometimes see this. Another adjustment is that in cash-free, debt-free deals, there is a minimum cash requirement for the seller. And if the seller distributes all its cash, the buyer needs to fund this. So you could argue that you shouldn't really subtract the total cash number to get the true price. You should really subtract the total cash minus the minimum cash. And so if we go with this formulation and make these adjustments, let's see what it looks like. We can start with the purchase equity value as always, and then we can take the target's debt, and then we can take the target's cash right here. We can then add the transaction and financing fees, which I have included in the sources and uses schedule right here. And then we can factor in the target's minimum cash balance, which we have assumed is 30 million right here. And if we do this and add it up, it comes out to a number that is slightly higher than the purchase enterprise value by about 50 or 60 million, something in that range. So there is a difference because of the fact that we're including these fees and also the minimum cash balance that the buyer needs to fund, but it's not really a huge difference. And because of the fact that this data is not readily available in most cases, most people will simply use the purchase enterprise value. So that's that. Now the second part here is much shorter. The seller proceeds in an M&A deal. For public sellers, it's pretty straightforward. The shareholders simply get the offer price per share times the number of common shares. So it really is just the purchase equity value. In a cash-free, debt-free M&A deal, the seller repays its debt using its cash. Any remaining debt is deducted from the shareholder proceeds. And then if there's cash remaining, that actually adds to the proceeds. So if you think about it, the seller proceeds in a cash-free, debt-free deal are just the purchase enterprise value that the deal is based on. You subtract the debt and you add the cash. And that's exactly the same as the formula for the purchase equity value. And so this is why the purchase equity value represents the proceeds to the seller regardless of the deal type. The next point here is the true price in M&A models for accretion dilution. So the issue here is that the seller's existing debt and cash barely make an impact in most cases because of how they work after the deal close. In most M&A models, the purchase equity value is actually a more direct driver that is used to calculate the EPS accretion dilution and also the cash, stock, and debt used. And if you go back to this model, you can see what I mean. In each case here, To determine the cash, debt, and stock that are being used to fund this deal, we are basing them on the purchase equity value, not the purchase enterprise value. So the cash used is based on the amount needed for the purchase equity value versus the minimum cash and the total amount that's available. The new debt issued is based on the purchase equity value minus the cash used, and we compare that to the maximum debt the company can use. And then the stock issued is based on the purchase equity value minus the cash and debt used. The reason for this is that, first off, if the buyer gets the seller's cash after the deal closes, the combined interest income stays the same. So in other words, if we look at this model and we look at the interest income for the buyer and for the seller, it's about $3 million total, and we look at the combined income statement, this $3 million of interest income stays the same. The fact that the seller has this cash balance and that the buyer gets the cash after the deal closes changes nothing because they're still earning the same amount of interest income on it. With the debt, if the debt is assumed or refinanced, the combined interest expense also stays the same. There may be a minor adjustment if the interest rate changes, but again, if you look at the acquirer's numbers here, so the interest expense of $24 million and then the target's numbers, interest expense of $15 million, the total here is simply $39 million, and this stays the same afterward. Regardless of whether the buyer assumes that debt and keeps it as is or refinances it and replaces it, you still have $250 million of debt for the seller. So nothing here is actually going to affect the $3 million in interest income and the $39 million in interest expense. Only the amount that the buyer pays for the seller's common shares, the purchase equity value, makes a net impact on the combined income statement. That's the only one that will actually change it over what it would be if you just combine the buyer and seller's statements without any adjustments. So there will be a foregone interest on cash, interest paid on new debt issued, and new shares from stock issued, and you can see all of them right here. So foregone interest on cash is based on the cash used to fund this deal times the pre-tax cost of cash. And then the interest paid on new debt issued is based on the new debt issued to buy the seller's shares times whatever the interest rate or coupon rate on that debt is. And then finally at the bottom, the shares issued in the transaction. If we go up here, this is simply based on the amount of stock issued, the dollar amount divided by the buyer's share price. And of course, the dollar amount of stock issued is in turn linked to the purchase equity value. So that's about it. Let's do a quick recap and summary now. The purchase enterprise value is the real price because at a baseline, the buyer needs to pay for the seller's shares. That's the purchase equity value. And then any debt that the seller has effectively increases the price because the buyer either needs to repay it or assume it or refinance it. And no matter what it does, that debt is now the buyer's responsibility and it will need to be repaid in the future. Any cash that the seller has effectively reduces the price because it either goes to the buyer after the deal closes or it gets distributed to the shareholders, in which case the purchase equity value goes down. The seller proceeds in the deal are always the purchase equity value for reasons we went through. In public deals, it's very straightforward. In cash-free, debt-free deals for private companies, this happens because of the way the debt must be repaid out of the proceeds, and then the excess cash remaining after that goes to the shareholders. And then the true price in M&A models, you will always calculate the purchase enterprise value. It's just that, as you saw, for a lot of these calculations, including the cash, debt, and stock used and the accretion dilution, the purchase equity value is the key driver here because the fact that the target has debt and has cash and has interest income and interest expense, this doesn't really affect line items like the foregone interest on cash, the interest paid on new debt issued, or the shares issued in the transaction. Instead, it only really affects the combined interest income and combined interest expense. But these are always going to be here regardless of the deal type or what the buyer does with these items from the seller. So that's about it for this lesson. I hope this clarifies some of these points, and I hope you have some better examples now of how this works in Excel.